Here we go. All right, so good evening, ladies. Again, thanks for joining me tonight. I'm going to go ahead and record this so that folks that missed it are able to go ahead and catch up. I had a couple folks that had asked me about that. So I'm going to go ahead and kind of go ahead and get started. I'm going to keep everybody on mute for the time being so that you guys can hear me well. I've got a bunch of information. I'll go ahead and kind of proceed and present. And then at the end, any questions on anything mortgage related, home buying related, we'll just go ahead and we'll kind of tackle them at that point. So if at any point you got a question, again, if you want to make a note of it, or since it's kind of a small group for right now, feel free to hop in and let me know. But if not, I will go ahead and get our party started. I'm going to go ahead and try to, give me 1 second. I'm going to go ahead and share my screen. I'm going to attempt to share my screen. Give me 1 second in there. Sometimes this thing likes me and sometimes it does not. There we go. So you should see a screen that says Fairway. It's got my info. So again, I want to thank you all for joining. So again, my name is Justin. I'm a loan officer with Fairway Independent Mortgage Corporation, licensed in Virginia, Maryland, and DC. I'm sorry, North Carolina, NC, not DC. So if you've got any needs or folks that are either looking to buy or purchase or even refinance in any one of those 3 states, be more than happy to go ahead and assist. Tonight's agenda is a couple things. Kind of our goal for tonight, or at least on my end, is to go ahead and I'm going to go ahead and kind of give you a quick intro on Fairway, go over a couple of key terms throughout the mortgage process, as well as the details on that. In addition, I'll go over to, like I said, not only the details for the process, but also just some general kind of trends within the market right now. And then I'll go ahead and take any questions as well once I go ahead and finish all that up. So give me 1 second. Not sure why, but my screen is not liking me. There we go. One quick second. Alrighty, we all can see that by now. Okay, sorry about that, little technical issues. Should be good to go. So a couple things as far as, again, the process itself. So a little bit about Fairway. So Fairway, we've been around since 1996, founded and still run by the same gentleman by the name of Steve Jacobson. Steve, or Jake, as he likes to kind of go by, fantastic guy. And I sincerely mean that. There are a few folks that have a senior leadership position, especially of an organization of this size, literally all across the country. One of the largest mortgage corporations literally in the country, and just a very, very humble, good guy. So overall company, one of the largest independent mortgage companies in the country. When I say independent, all that just means is that we're not a typical bank. We don't do credit cards. We don't do bank, like mortgage. Other than mortgage, that's all we do. No car loans, no credit cards, no checking, savings accounts. It's only mortgages. But we try to be very, very, very good at mortgages. Also a little bit about Fairway itself. So we're one of the largest independent mortgage companies in the country. And then in addition to that, if you look at the top 10, most of which you've probably heard of before, we actually do more purchases than any other company, period, in the country. So you can look at, whether it's Wells Fargo, Quicken Loans, Rocket, loanDepot, like all the major names throughout the country, that anyone that does mortgages, Fairway does more business on the purchase side by percentage than any other company in the country. For the most part, most of the other companies that are out there, they do a large portion either in refinances. Maybe it's 50-50. Loan Depot or Rocket Mortgage, a lot of the other ones that are very well known, they predominantly work in refinances, whereas the nature and the heartbeat of Fairway is to really help folks obtain home ownership. So that's our main goal, is to get folks into homes. We do refinances, of course, like everyone else, but it's not our main focus. Our main focus is getting folks into homes. When Steve first founded the company in '96, he's been in the business for a very, very long time, and his driving passion was to do home loans the fair way. So a lot of times there's so much sometimes negative publicity around or negative kind of mantra around the mortgage industry for a lot of things that happened in the past in the late 90s, early 2000s. That the mortgage world has kind of got a bad rep, but Steve was very, very adamant that he wants to do loans the fair way, and that's how he came up with the name. When I first came on board as a team, I hear fairway and I think of golf course, even though I'm not a golfer. But it was made very, very clear directly from Steve and the entire senior leadership team that's the heartbeat of Fairway, is to do home loans and do mortgages the fair way. And then predominantly, again, our focus is to get folks into homes. So we will go above and beyond to do anything and everything for folks that we're working for to get them into their homes. So that was a little bit about Fairway. Next thing is kind of some key terms I want to go through and kind of define. So we'll go ahead, and there's four main things that are important to understand anytime you're going through and looking at purchasing a home. And these are the four kind of main categories that we'll dive into a little bit deeper. So sales price, down payment, closing costs, and then the loan itself, the mortgage. So we'll look at the first one, the sales price. Basically, sales price, all that is just the agreed upon price that you're trying to buy a home for. No different if you're going to try to buy a car. It might have an MSRP or, it's a sticker price of X amount, but the actual final agreed upon price might be, less than that in most cases if you're buying a car. Basically the same thing with a mortgage. People might be asking a certain price. Whatever the final agreed upon price is considered the sales price, which is important, especially as it relates to, down payment percentages and those kinds of things. So sales price sounds pretty easy, but just to be clear, second term I'm going to go through is down payment. Down payment, generally speaking, is referred to, it's kind of defined as whatever out-of-pocket expenses or portion of them are used to go ahead and to secure the home that you're purchasing. This is different than closing costs, which we'll talk about in a second, but down payment is specifically, and they usually do it as a percentage. So if, for example, if you're going to put 5% down as a down payment to go ahead and purchase a home, that would be a 5% down payment, and then you would have a 95% mortgage. They call it loan to value ratio, and ideally you want to have that. Everyone's situation is different, but again, it goes kind of based off percentage. So down payment is usually a percentage or a dollar amount that's used to go ahead and invest into the home to make that purchase, possible. So down payment, there's a couple of different options as far as basically how those down payments are funded. And this is why everyone's situation is very, very unique and very different. So a couple of different options. In most cases, down payment will just be paid by the buyer. So I have buyer paid, which just means it's, whether it's checking or savings or whatever, but you've saved up funds that you want to go ahead and use for to go ahead and purchase that home. So buyer paid, down payment. In some loan types, there's options where you can have gifts. It gets very, very specific in the loan program. Some loan programs allow them, some don't. Even gifts that do come in, there's usually a percentage or a dollar cap that are allowed as gifts. But that is another option, that a family can give you a gift to go ahead and help secure and provide for assistance with down payment. For third option is lender credits. If these other three options don't necessarily go through and aren't always great or don't always work out for the particular situation, there's also options where lenders can actually give credits back. And basically the way that works is it's tied in with interest rates. So the way that rates work, see that Marvin's doing this. Thanks, Marvin. The way that rates work is that, if whatever the standard rate is, generally speaking, in exchange for kind of money back to help offset whether it's down payment or closing costs, lenders are able to give a dollar amount back based off of that rate. So let's just say that for the sake of illustration, that the normal 30-year mortgage rate right now is 3.25. Is 3.25. If you needed to maybe hunt down some assistance for closing costs or out of pocket, down payment, lenders were, for an exchange for a slightly higher rate, they can give you back a dollar amount for that. So instead of 3.25, let's just say that you were to go with 3.5. That would allow a lender to give funds back to help offset some of those out-of-pocket expenses for down payment to the borrower, which is very, very commonly done in a lot of situations. Fourth option that I have listed on here is called DPA programs, down payment assistance programs, and those are going to vary a lot depending on where you're at. Some of those are county specific. There's also a lot of ones that are set up at a state level. Almost every state in the country has their own specific programs, which I'll talk about for Virginia is kind of a little bit towards the end. But basically the short version of that is that there are options where, there are certain programs, whether it's a down payment loan or a down payment grant in some cases, but where borrowers can go through and actually qualify so that even if, let's just say that you need 3% or 5%, whatever the number is for a down payment, if you don't have all of those funds, a lot of times you can go ahead and qualify. Borrowers can in some cases qualify for an assistance program of some sort, as long as they meet all the criteria. So you might not have 3% for a down payment, but a lot of times you can get basically financing for that. And again, some folks can actually qualify for certain grants depending on their specific situation. So that's kind of an overview as far as down payment goes. So next item, and again, if I'm going too fast, feel free to let me know, or if you have questions, just feel free to go ahead and write them down as we go. And then at the end, I'll go ahead and take any questions from anybody on anything. Closing costs, and the way that I kind of describe them is that at the end of the day, it's not like it's a separate item. It's money out of pocket, right? So if you go to buy a home, you're not going to have one check for down payment and a separate check for closing costs. It's all kind of lumped into that same payment amount, but they're just called different things. In closing costs, basically what there are, there's a bunch of different things, primarily that are broken down into 4 different groups as far as closing costs and what they're made of. But it's basically a kind of a synopsis. Let me go to this next screen. I can go ahead and kind of go through. But it's basically any one-time fee or tax or anything like that that's related not to. It's not investing in the value of the home. It's not like the down payment where that's going to be used to go ahead and secure, as equity. That's going to be part of the home's value. They're usually single-time fees that are associated to buying a home. So like, for example, if you're buying a car or you go to buy whatever, you go to the grocery store, there's sales tax, that's a one-time tax on that specific purchase. And that's how a lot of, generally speaking, how closing costs work. Most of them are single one-time fees related to the specific purchase of that home. So closing costs are broken down into, generally speaking, about 4 different buckets, so to speak. So the first one is lender fees. Lender fees, or they're also called origination fees, is basically out of all of your closing costs. Everything in Virginia is typically around 3%. So for example, if you're buying a home for $400,000, typical closing cost will be about 3%, or about $12,000 out of there, $10,000 to $12,000. So out of that entire $10,000 to $12,000 amount, the only thing that is going to change, generally speaking, or should change, is really your lender fees, or your origination fees. So Fairway, for example, we have a one-time flat amount for our lender fees, which are a little less than $1,500, $1,495. And they break it down, X amount is for underwriting and processing and that kind of thing. But generally speaking, that's the most significant difference that you're going to find company to company. So your title and government fees, the escrows, everything else that's in there should basically be almost identical, regardless of what company you use, whether you use Fairway or another company of any kind. So when you go through and you're looking at lenders, part of that is not only, again, kind of understanding the whole process, and all the kind of ins and outs, but really working with a loan officer that you're comfortable with, being able to go through and understand the process and, again, know what's specific to them. So again, so lender fees, that's going to be your biggest variable. And even though it's a teeny tiny part of the whole picture as far as closing costs goes, it is important just to kind of understand that. So a lot of times when I talk with folks, usually for the first time or maybe the first couple times, they talk about closing costs and how much that is, and, what are this fees and that fees. I go through and I try to explain that for the most part, all your closing costs are going to be almost identical regardless of where you go. One company might present that information differently, but ultimately the other items that are on here, like your government fees and taxes, that's going to be the same regardless. Your escrow and prepaids, again, that's going to be the same regardless. And then title fees are going to be the same. And actually, as the borrower, you're legally obligated that you're able to pick whatever that title company is. So someone might present a different number, but again, it's actually up to the borrower. And that's one of the disclosures that you go through and sign off when you buy a home. It's just that says that you have the right and the ability to pick whatever title company or settlement company you choose. It's not picked by the lender in any way. So my job is to make sure that whatever they charge, that I'm reporting that accurately. But ultimately we don't pick. I'm more than happy I can recommend. For the most part, I regularly will go through and I'll get price quotes from almost every major settlement company in Prince William or whatever kind of region we're going to be looking in. So if you're looking for Fairfax County, I can pretty much tell you within, a couple seconds which companies are better to work with and which ones are more expensive, because it's very shocking sometimes, how significant fees can change, again, just based off of what company you use for settlement and for title. So knowing that information is important. I've got usually two that I kind of lean towards. One's in Prince William County and one's in Fairfax. Then I have a third one that does everything remote, so even if you want, you don't necessarily even have to go somewhere. They can send they call it a mobile notary, but basically someone to your home or place of business, your work, to go ahead and fill out paperwork, at your home. So you don't even have to go anywhere in some cases. So those are usually my big three, but I usually pick them specifically because they're incredibly affordable. If their service is fantastic, and I've worked with them, and they've, like I said, just have a great history as well as also a great track record of just being really, really, really good. So lender fees, kind of went over that. Title fees, more specifically, what title is. Title is sometimes it's important to kind of understand because some of it, when you're going through the process isn't always explained super, super well. Let me go back one more time. Sorry about that. So lender fees, like I said, Fairways is $14.95. Title fees, there's a bunch of different fees that go in that. A lot of that has to do primarily with making sure that the home is basically that you have clear ownership on that house. And there's a bunch of different stuff that goes in that. There's recording fees, so once you go ahead and you sign documents, that title company, their job is to take those documents and record them down at the local courthouse for whatever county you're in. They also do a lot of research on the back end that for the most part, you never will know about, which is good. It's kind of like that old phrase, if it's not fixed or it's not broken, like don't fix it, or no news is good news. It's kind of the same thing. Title fees, title insurance specifically is one of those things that like you never, kind of like car insurance, like you never want to need it or want to use it, but when you do need it, it's really, really important. So there's a bunch of kind of things that go into title fees. And like I said, most of them will be fairly comparable in some cases, but there also can be a couple of items that's closing fee, settlement fee, title insurance, those types of things, which can vary. And that's why it's important to be able to go through and either work with knowledgeable loan officer that kind of has a good understanding, not only for the loan process, but also the closing process, as well as good companies to go ahead and utilize that have great service as well as affordability. Other thing on title, and I'll move on to the next one after this, is there's two types of title insurance, it's called. One is an owner's policy, and then one is a lender policy. And this can be really, really easy to kind of forget which one is which. Basically, anytime you purchase a home, you're going to be asked if you want to buy owner's titles insurance policy, like an owner's policy, which is something that you always want to do, just to be completely straight and honest. Basically, what that insurance is for is to make sure that the home that you're buying, they insure it to make sure that there is no gaps, no hiccups whatsoever, no issues with purchasing that home. And that might sound like a really weird kind of like ridiculous thing to even like, like how often does that come up? But it comes up all the time. So for example, an issue where this might be an issue, this might cause a problem where you would actually need to utilize this. I had this 2 weeks ago. It came up with me. I was working with a borrower who was going through and refinancing their home. And when we went to go ahead, title company was doing their job. They were researching the title history, which is basically just the transfer of ownership, the entire history of that property going back to its construction back, decades ago. And they found where two people had, or on two separate occasions, there had been a lien that had been filed against that property that the homeowner had no idea about. It had nothing to do with her. I was actually kind of surprised that it wasn't picked up on when she purchased the home. But basically it comes up as a lien, which just means that you can't sell that house or refinance that house until these liens are removed. So for example, if you don't pay your taxes, the government can put a lien against your house that says, hey, this house can't be sold until we get paid. They have mechanics liens, which is, if you get a lot of work done on a house and then, the workers don't get paid, you try to, for whatever reason, there's a dispute and there's a debt that's owed. There can be a mechanics lien on a property, which again says, hey, you can't refinance or sell this house until this debt is paid off. So basically what title insurance does is it just makes sure that when you purchase that home, they ensure that there is no problems whatsoever. Not to get too much into the weeds, but there's a lot of times where anytime there's someone that is legally listed on the house as an owner, they have to sign off on stuff anytime it's sold, and you'd be surprised on how often that's not done correctly. So for example, let's just say that you go tomorrow, you buy a house, everything's great, you move in, everything's fantastic, you repaint it, and 5 years from now you get a knock on the door, and someone's like, oh, hey, my name is so-and-so, and my father owned this house 15 years ago, and it was never transferred correctly, so actually I have 20% ownership in this house right now. And you're like, what are you talking about? Like, where did that come from? When I bought this house, I thought it was clear. But again, if there's an issue and, maybe this person's, father or grandfather or whatever, he owned it with two or three other people, four other people, whatever. And when he sold it, not everyone signed off on that document. So maybe there was one person out of three that was missing. That means that they still currently have, 33%, 1/3 ownership in the house that you just bought. And that's a bad situation that you are in. So what title insurance does, again, it allows basically, in case, Joe Schmo shows up at your door 5 years later and says, hey, I've got a legal right, I have legal ownership in this house that you're unaware of. That's when the insurance comes in to basically say, hey, we're going to pay you to go away. We're going to make sure that this doesn't impact the current owner since they bought it. And everything should have been clean, but since it wasn't, we're going to kind of come in and make sure all that stuff is taken care of. So owner's policy on title is super, super important. So when you buy a home, that's the only time that you really need that, is the first time that you purchase it. Thereafter, you have the owner side, and then you also have the lender side. So the owner's is optional. And that's why I say it's really important to make sure that you purchase that anytime you buy a home. The second one is the lender's, basically the same thing, the lender's policy. And that's something that will come up anytime you buy a home or refinance a home. It happens from time to time where we'll go through and somebody will like, we see, some of the numbers and stuff on the documents right before closing and whatnot. And they're like, hey, I see that there's a lender's title insurance policy, but I got that, when I bought the house. But again, that's going to be taken out again anytime you get a new lender. Because it's designed to protect them specifically. But again, that's a one-time thing. It's not, it's only paid once. So anyway, so a lot of boring information about title, but it's also really, really important, again, that when that comes up, that you guys are kind of aware of that. Because again, title, it's one of those things that, again, it's like auto insurance. Hopefully you never need it ever, but when you need it, it's really important that you have it. So that's title. Next to on here, government fees and taxes. So anytime you buy anything, you're going to have taxes at the state level as well as the local level, at county level. So those will be the exact same anytime you purchase. And then the final one on here, prepaids and escrows. Escrows is just basically a fancy way of saying your mortgage savings account. So when you buy a home, it's going to be the lender's responsibility to make sure that your county taxes are paid. on time and that your homeowner's insurance are paid on time. And the reason that they do that is really to kind of actually protect you as the homeowner. I had a buddy of mine, it's a really bad story, but a buddy of mine where, they recently had paid their mortgage off, so they actually owned a property free and clear for the first time in like their life. And the long story short was that they, at that point, it became their responsibility to make sure that they paid the homeowner's insurance on time. And in doing that, long story short, again, is that they, because of some issues with the mail, they missed the payment or the bill that came in for the homeowner's insurance policy, because that's usually only once a year. And as a result of that, their insurance lapsed. At the time, they were renting the home out, and the folks that were in there, they had an accident in the house, and the house got fire. And since because there was no coverage at that point because the insurance had lapsed, they literally lost like everything, like the entire house gone. And with no insurance, there's literally nothing that you can do about that. So again, so escrows are important again because they'll make sure that lender will make sure that your homeowner's insurance as well as your taxes are paid on time. So again, so part of that is to set up that kind of savings account to make sure that the amount of funds are in there and they're when they're needed that they're available. So they'll go through, and part of your payment every month will be to kind of go into that savings account, that escrow account. And then the other half of that are prepaid items anytime you go to close, which is generally speaking, it's just going to be interest in most cases. So when you buy a home, it's just like your credit card or any other loan. Interest is basically racked up every day, even though it's paid once a month. And usually when you go ahead and you close, you're going to pay interest from that day through the end of the month. And then you have your first payment usually the month following. So like, for example, today is the 2nd. So if you were closing on your home today, you would pay interest through the end of this month, through the end of March. And then your first payment would actually be the 1st of May. So it's kind of weird how it works out, but that's a prepaid item. Other thing on prepaids would be when you're buying a home are going to be your homeowner's insurance. That's one of those things that's paid up in advance. So it's, again, a bunch of different items, but those kind of all come into that one big bucket of closing costs. So you got lender fees, title fees, government stuff, and then your escrows and prepaids. And those usually make up, like I said, on average, about 3% of the total purchase. So anyway, so that is closing costs. We will keep moving right along. The last item on here, we're going to go through and define is your mortgage loan, the loan itself. Again, so kind of working backwards, your mortgage loan is going to be basically whatever amount is needed to finance the purchase of that house. So very few people can afford to just go through and just buy a house with writing a check in cash. So usually a loan is needed to go ahead and secure that home. So if, for example, again, you're putting down 3% or 5% or 10 or whatever the number is as a down payment, your mortgage is going to be the balance of whatever that number is. So if you're putting down 5%, you're going to have a 95% loan. If you're putting down 20%, you're going to have an 80% loan. As far as types of loans, so there's generally speaking 4 types of loans in the country. Now there's like a million different variations on each one, but there's really only 4 types, generally speaking. Conventional loans, and I'll go through and define kind of all these. FHA, which is short for Federal Housing Administration, FHA loans. VA, or Department of Veteran Affairs. Those are available only to folks who have served in the military. And then the last one is USDA or rural, which again is a really good loan program, but those are tied in to kind of specific geography. So I'll go through and kind of give you a little kind of nugget on each one of these 4, and then kind of brief pros and cons on each. So as far as conventional loans, generally speaking, unless you're eligible for a VA loan, like VA loans are by far the best loan options available for the first time that you're buying a home. So if you're eligible for VA, that's the way that you always want to go. But next to VA, conventional is the most ideal in most situations for most people. If you're able to qualify for conventional, that's usually the route that you want to go. And there's a bunch of different reasons for that, but generally speaking, that's kind of just the short end. Conventional loans, they're set up and kind of governed or regulated. They call them by GSEs, by Freddie Mac and Fannie Mae, and all the kind of rules and regulations about down payment and income and qualifying and all that. They're kind of managed by or governed by these institutions. But again, generally speaking, they're not an actual government loan. FHA, VA, those are both government loans. They are issued and insured by government agencies, whereas conventional are not. They are tied and connected with government regulation, but they're actually private companies, Freddie Mac and then Fannie Mae. So just kind of a brief overview. We should move to FHA first, and then we'll get back. So FHA is another really, really good loan program for folks. A lot of folks go FHA if they're going to buy a home for the first time. The main difference on conventional and FHA is, generally speaking, let me rephrase that. Some of the main criteria on why you would go with one versus the other is going to be credit score, as well as down payment amount. So generally speaking, conventional loans, you have to have at least 5% in most cases to qualify for a conventional loan. FHA has a lower down payment requirement. Theirs is only 3.5%. Another kind of difference between the two is that conventional has a lot of things that are heavily, I'll just say, weighted on credit score. So for example, top score for conventional loans is 760, even though, you can get up in the 800s as far as your score. But as far as, where that benefits, 760 is kind of the cap. So it starts at 760 and then goes down every 20 points from there, 740, 720, all the way down to basically 620. And for every bracket from there under, basically, there's a lot of variables within that loan that'll change. Your rate will change. Someone with the exact same down payment amount, the exact same level of income, if you have a credit score of 680 compared to 760, you're going to get a totally different rate. The higher the credit score, the higher the rate. The better the rate, lower the score. So you get better rates and also mortgage insurance if it's needed on a conventional, tied in directly with credit score. So conventional can be really kind of complex because there's a lot of stuff that kind of go in play. Like I said, down payment amount, credit score are really, really important. Kind of the big advantages of FHA is that for the most part, everything is standard. So it's not like there's a higher end or a lower end on FHA. It's either you qualify or you don't. So you can go in and go FHA. Again, you have more flexible credit. So for example, for conventional loans, a lot of times you have to have, COVID's a little different, but generally speaking, like right now, you have to have a score of 640 or higher to get a conventional loan, generally speaking, through Virginia Housing, for example. So folks that don't have a 640, maybe have a 630 or a 620 or whatnot, they just might not qualify because credit score isn't high enough. So that's one case where FHA is really beneficial. Another thing with FHA is that they have their mortgage insurance is the same amount for everybody, regardless of what your credit score, which is the opposite with conventional. So, for example, anytime you have less than 20% as a down payment, there's always going to be mortgage insurance of some type. Where it is or what it's called, might change, but it's always going to be there in some capacity for these two programs. So, for example, with conventional, again, if you have a smaller down payment, if you have a lower credit score, your insurance is going to be higher. It's just like your car insurance. They want, they want, no tickets, no speeding, no perfect track record as far as your driving record. And you do that, you get the best, insurance rates that are available for your car. And it's kind of the same thing with mortgage insurance. The closer that you are to that 20% down payment and the closer that you are to having a higher credit score, the better your mortgage insurance is going to be, which is paid every month. With conventional and again with FHA, there's just a flat percentage and that's it. So FHA does have a percentage that's kind of charged up front for mortgage insurance. They call it a MIP, upfront mortgage insurance premium, and then there's a monthly amount. But generally speaking, and again, it depends a little bit on the situation, but FHA is a really good option, again, because their mortgage insurance is a flat amount, doesn't change. They have lower requirements as far as that, down payment and credit and those kinds of things. The only downside to FHA is that mortgage insurance, for the most part, it's always going to be there. On conventional loans, once you pay down to less than 80%, 78%, your mortgage insurance can be dropped. Whereas with FHA, unless you put down at least 10% up front, that FHA mortgage insurance is going to be there for the entire life of the loan. So you could have it until you almost pay the house off, and it's always going to be there. So that's why a lot of times folks that maybe might be moving into a home for the first time and might not have either a lot of money for down payment, or your credit might be less on the lower end of the scale. FHA is a really, really good option. And a lot of folks will try to refinance that once they're eligible to get into a conventional loan once that option pops up. So that's kind of the major differences with FHA and conventional. And again, each situation as far as which one is best really depends on the specifics for that borrower. And that's why the folks that I work with, we go through a lot of detail on each one to see which one is best. Because again, it depends on the goals of each person. You might have somebody that could, technically have a lower payment with FHA, but if they plan on being in that house for a long time and they don't have any desire to refinance at some point, it might be better to go conventional. So those are those two. VA is the third one, again, which is only available to those who serve, as kind of the nation's way of saying thank you. VA has, I'm not sure why. I know historically there's, for whatever reason, sometimes I have to correct this with folks, but VA sometimes has a bad rap. A lot of folks that I work with or talk to that are eligible for VA, they're like, oh yeah, I heard, this about the VA, or VA is not good or whatever. But it's literally the best financing in the country. Rates are always better than any other program, period, generally speaking. There's no mortgage insurance at all, zero. So it's really, really good. So as a veteran that served, you're able to go ahead and they have, they call it a funding fee, which just says, hey, if you're going to use our program, there's a one-time fee. But even that doesn't have to be paid out of pocket. You can just add it into the loan. And it's very similar dollar amount to FHA, except again, there's no monthly mortgage insurance. So, if you have two folks that are buying the exact same home, exact same, income and everything else, VA is always going to be more affordable, generally speaking, than any of the other options. When you're looking at a smaller down payment amount, because again, there's not going to be any insurance. In some cases, it's based off of, again, percentage and a bunch of other things. But, your mortgage insurance can be anywhere from FHA is a little less than 1%. It's 0.85 of whatever your total loan amount is. Or it can be, up to 1.6 or even higher, 3 or 4% with conventional. And again, FHA or VA loans have zero, so that can save literally hundreds of dollars every month by going VA for those that are eligible. So VA is a really, really good option. Last but not least is USDA. It's kind of similar, is that it's a zero down payment loan. The only thing with that is that it's tied in with certain geography and zip codes. And it's generally designed for those that are in rural areas. So believe it or not, Prince William County, parts of Prince William are considered rural, basically west of Haymarket and Gainesville. So some areas out there qualify, but there's also basically an income cap as well. So you can't be, there's certain, again, tied into geography and zip codes and whatnot. There's a certain dollar amount, you can't make more than X amount to qualify for a USDA loan. But again, it's another good option for folks that are looking to have minimal out-of-pocket expense, because it is one of very few that allow for no money no down payment or no money down. So anyway, so those are the four kind of main types of loans: conventional, FHA, VA, and USDA. Next item I got on here is, pull this up, is first-time home buyer. Some of you guys are familiar with this. Other folks, this is just kind of an overview. So right now, and I've kind of explained this with folks that I've worked with in the past, there's certain funds that are set aside on a national level to help folks obtain home ownership for the first time. And then each state usually has their own organization that's responsible for the distribution of those funds. So for Virginia, right now, we have Virginia Housing. Historically, it's been called forever VHDA. They've changed their name to Virginia Housing, so that's why I have both of them up there. Most folks that have been around a long time They're familiar with VHDA, just that name, but they are changing to Virginia Housing. So you'll hear more and more of that in the future. But basically, one of the things that's really, really, really good about Virginia Housing is that any perks whatsoever that are available to first-time home buyers are available only through them. So the way that I kind of explain it is that there's not a specific first home buyer loan. There's just better versions of all those loans we just looked at that are available only through Virginia Housing. So for example, let's just say that I've got somebody that's looking at doing a minimal down payment. Maybe they're looking at an FHA loan because of it kind of meets their specifics. If I was just to go straight to FHA, I would get one rate. If I go through the doorway of Virginia Housing because they qualify, I would still be able to get them an FHA loan because Virginia Housing offers all the same loan types. They're just a little bit better. So generally speaking, you get a little bit of a better rate anytime you go through Virginia Housing. And then really where it's a huge benefit for folks that are first-time home buyers is that there's certain down payment assistance or closing costs options, kind of getting back to that one of the slides that we talked about earlier, that are only available to folks that go through Virginia Housing. So for example, I'm working with some folks currently, that aren't first-time home buyers, which means that if they want a home, they have to come up with 3.5% at a minimum to go FHA. With Virginia Housing, they have a really, really good program. And what it is, it's called basically a second piggyback loan, which, for lack of a better term, it's basically it's kind of like a loan for the down payment that's needed. So for example, for FHA, you need to have 3.5%. Right. Let's just say that maybe you don't have 3.5%. So what Virginia Housing does is say, hey, if you need 3.5% for that FHA loan, we'll just give you a loan for that amount. And then that way it's basically zero money out of pocket as far as down payment. You still have closing costs and stuff that need to be paid in some way. But as far as the down payment itself, Virginia Housing has options that can go ahead and help complement that to minimize out of money or out of pocket expenses for down payment and that kind of thing. The other side of Virginia Housing is that they have not only down payment assistance loans, but they also have down payment assistance grants. And those are only available through Virginia Housing. So basically the way that the grants work is, again, they're all tied in with income. You can't make more than X amount. And that depends on what part of the state. The Northern Virginia area kind of as a whole, it's a little less than $130,000 for a household, and that includes all adults that are in that household, even if they're not on a loan. You go to Richmond, that area is significantly less. But for the grants themselves, as long as you qualify and don't, they kind of go through again all their qualifications. And sometimes if you qualify, they can just give you a grant. So for example, if you're going with a VA loan, for example. VA loan, again, there's zero down payment requirement, but you still have that 2 or 3% that are needed for closing costs. And again, if that's $10,000 or $12,000, that's a lot of money. So Virginia Housing can come in and they can, in some cases, give you a grant for up to 2 or 2.5% of whatever your purchase is. So if you're buying a $300,000 house, they can give you a grant for VA loans of basically 2%, of nearly $6,000, which makes your out-of-pocket significantly less. And again, that's a huge advantage in this market, which is so competitive, because if you don't need to ask the seller for closing costs because you can get them as a grant or even as a second loan through Virginia Housing, it'll put you in a really, really good position to be more competitive with that many more folks that are out there looking around for houses and stuff. So Virginia Housing is phenomenal. Anytime I'm working with folks that are first-time home buyers, that's one of the first things that I talk to them about. Because it's so important, one, to see if they qualify, and if they do, what programs they qualify for. And then again, to make sure that whatever options are available to them, that we explore every single one of them. Because some things might be advantageous for some folks and not for others. Or even if folks qualify for things, they might not want that specific program for whatever reason. So it's good to kind of talk through all of those options. And again, the really good thing about Virginia Housing is that it costs you $0 to get access to their things. The only thing that they require is, again, to make sure that you meet their income requirements. and really that you take their online training course on homeownership, which is absolutely free. It takes roughly about 6 to 8 hours to complete. But once you take their course, it allows you access to all the options and programs that they have. So really, really good option for folks, especially buying for the first time, especially in this area. Again, because sometimes you qualify for just free funds that they can give you as a grant. And again, if you're looking to keep it as minimal out of pocket as possible, again, even if you don't qualify for grants because of income caps, you can still qualify for secondary loans. So it basically still becomes a zero out of pocket purchase, no down payment kind of purchase. So it's really, really good options that are out there. So anyway, first time home buyers. Other thing on top of that, in addition to the state level, is sometimes there's actually stuff that's even available by county. And again, that's why it's really, really important to work with a loan officer that's very, very detailed and will put in the extra time and energy. I can't tell you how many times I've talked with folks over the last 6 months where they've talked with other lenders or they've been pre-approved with other folks and they're first-time home buyers, and then I start talking to them about these things and they have no idea because it's not communicated to them or because maybe whatever the case is. So you have state level options and then even, again, you have county level options. If you look across Virginia as well as Maryland as well, Prince William County as well as Loudoun have two of the best options, period, as far as folks for first-time home buyers. They're very, very restrictive. You have to qualify, and it's primarily geared towards folks, generally speaking, that make less than the average area income. So for those two counties specifically, it's like less than roughly about $80,000. So if you make less than $80,000 as a household, there's a lot of additional things that are available to them in some cases, again, through those two counties specifically, which are really, really good options. So again, that's why it's important that when you are working with someone, just that they have an idea of not only, the price that you're looking for, but also the regions that you're looking for. And that's one of the questions that usually I'll ask folks is if you have, even if it's not a specific county, but maybe one or two that you're, kind of ideally looking into, so that for me, that gives me the thumbs up to kind of, narrow in my search so that when I'm reaching out to, housing departments within those local governments, if there's options that are out there that, I can make sure that I thoroughly research those on behalf of the folks that I work with. So anyway, first-time home buyers, I will keep on rolling. That's that. Next thing is the loan process, and I know it's already 7:50, so I'm going to try to go through these really quick. I'm just going to define these terms as the way that I use them, because you'll see these terms that are kind of thrown out there, and they're used differently by different folks. Pre-qualification and pre-approval, I use those two very, very differently. Pre-qualification is when I talk to someone, usually it's on the phone. They present information to me, and I say, hey, based off that information, you should be pre-qualified for a home of X amount. That's usually very easy to do. I can usually do it on the phone or within a couple hours, generally speaking. It's a matter of just, understanding assets, how much, down payment or income and, monthly expenses, those kind of things. But it's always the way that I use the term is used for folks that are presenting information that has not been verified. So that's pre-qualification. Pre-approval is when I, as a lender, a loan officer, will go ahead and take all that information as it's presented, and then I verify it. Right. So if I have folks that say, hey, our household income is $100,000 a year, and we are looking for a mortgage payment of X amount, I say, hey, that's fantastic. We need to document all that stuff now. So if you're going to say that you're going to put 10% down, like I need to document to make sure that I can show that you have those funds available. That if you say that you make $100,000 as a household, that we have, W-2s and pay stubs and these kinds of things to verify and document that all those things are set. And then usually once we have that information, as a lender, we can go ahead and issue a written pre-approval that says, hey, this couple, this borrower pair are pre-approved for a loan of up to X amount of dollars. So whether that's 300 or 600, whatever the number is, based off of the information that has been presented and has been verified, as well as doing a quick automated underwriting check, they should be approved for a loan of X amount. Next one is full approval. And this is really important. I'll go through this a little bit more detail in a second, but basically a full approval is when it's no longer pre-approved, but you actually have a written approval from underwriting, not me as a loan officer, but from underwriting that says these folks have been approved for X amount of dollars as a loan. And that's really important. And I'll get through that in a second as far as why that's important. So that's full approval. Usually in the process, so I'll usually pre-qualify folks over the phone or shortly thereafter. Once we chat and they get all the documents back to me that I need, I can get a written pre-approval. Depending on what's needed in the situation, sometimes I can do that in a couple hours. Sometimes it takes a couple days, just depending on how quickly things get back to me when I ask for them. So that's generally speaking up to the borrowers. Full approval, again, that's usually when everything is presented to underwriting and you get a written declaration that says these folks have been approved for a mortgage of X amount. That part of the process usually takes, for me, on average, 2 weeks, if from the point that I get everything that I need. I'll talk about that a little bit more in a second. And then once you have a full approval, at least with the folks that I work with, that's generally speaking when you go out and you want to start kind of looking around and shopping for houses. Last one is once you find that house, you get the contract and everyone kind of agrees that we're going to, buy this home for X amount. That's when usually a couple weeks after that, typically 30 days is when you'll go through and you'll have closing. And that's when you get into all the costs and fees that I kind of just went over. And then basically after closing, congratulations, you're a homeowner, which is exciting. So the last kind of thing as far as this process goes that I want to go through and kind of explain is really this difference on pre-approval and full approval. I'm going to show this next slide, which kind of talks about Fairway. Fairway is literally one of the only lenders in the country that will do full approvals on borrowers before you buy a house, before you find a house. I'll say that one more time. So Fairway is one of the only lenders in the country that will issue full approvals approved by underwriting, guaranteeing a mortgage before you find an address, before you have a house. So we call it, on the outside, we call it a 3-2-1-GO program. Basically that you go through underwriting first, you have a written approval for a mortgage, then you go out and you find your house and you close, easy peasy. Again, almost no one does this. George Mason doesn't do this. Rocket Mortgage, Wells Fargo, Quicken Loans, Atlantic Coast. You name it. Like almost, I know of one that I'm sure of, but like I said, the vast majority of the country isn't able to do this, and here's why. As soon as an underwriter touches a loan application, it costs money. That's how they work. They get paid as soon as they touch it, and the more that they touch it, it slows down their process. So generally speaking, mortgage companies don't want to go through the expense of having all this stuff looked at by an underwriter until they know for a fact that there's going to be a house that goes with that. And that's why, for the most part, no lender other than Fairway and maybe one or two others in the country will go through and actually have underwriters look at files, loan applications first before you find a house. So with our program, the 3-2-1-GO program, basically what this does, anyone that I work with, again, it does take a little bit more time. I can get a pre-approval usually in a couple hours. Full approval can take a couple weeks to longer, depending on the situation. But the good thing about this, when you go out to buy a home, and for real estate agents, they're going to be very familiar with this. If you're buying a home for the first time, part of the contract that you have to submit to the seller, if they have a thing on there, it's a whole page of contingencies, that basically says that, I want to buy this house, but I can only buy this house. They call it a financing contingency if I can obtain financing. So I got to check that box. 99.9% of the contracts in the country will be contingent upon financing, which again basically just means that, hey, I want to buy your house, but I actually can't until I have a written commitment from a mortgage company. With the folks that work with Fairway that I'm able to get full approvals on, you're no longer contingent upon financing because you already have a written guarantee of it. End of story. So what that means for the buyers, especially in a market like this, is that it almost allows you to go out and buy a home like cash, because at that point you're not contingent upon financing because you already have a written guarantee of it. The reason that is important, especially in a market like this, the market that we're in now is a seller's market. The analogy I use is musical chairs. So if you're, musical chairs, typical game, you got maybe 10 chairs that are out, and or well, let's say 10 people and 9 chairs. Music stops, maybe one person's left without, but generally speaking, everybody gets a chair. Seller's market is the complete opposite. You have 10 people that are walking around, but maybe you have 4 chairs, right? So music stops, somebody starts pushing someone, you get elbows thrown. It gets really competitive really quick. And that's because, again, everybody wants a seat, but there's just not enough seats out there. And that's basically the market that we're in right now. There's a lot of folks that are actively looking for homes, and there's a bazillion reasons why it is what it is, but there's just not a lot of homes that are actively for sale right now. Hopefully that will improve and change within the next couple of weeks as things get warmer. But as of this minute right now, it's definitely a very, very heavy seller's market. So anyway, so again, the reason that's important is that, let's just say that for the sake of illustration, you find a great home and you put a contract in with your agent, but there's also 2 or 3 or 4 or 5 other people also putting contracts in at the same time, right? So as the seller, you see that you have these 5 different options on who you want to basically sell your house to, and 4 out of those 5, they have pre-approval, so they should qualify, but there's no guarantee. No one actually knows for certain. It could blow up theoretically at any point. So if you have 4 out of those 5 have pre-approvals, and then you have number 5, which has a written commitment for a mortgage from a company saying they've already been through underwriting, like they're all done. As long as you're asking the same dollar amount, like there's really, like it's a no-brainer. Like it is guaranteed, like there's 0 risk going with this guy that's fully approved because there's no chance anything's going to pop up. It's roughly about a month ago, I had somebody in Fairfax in the neighborhood I used to live in that called me and said, "Hey, Justin, can you double check this? I got pre-approved by PenFed, who's a very, very large regional bank, credit union that does a lot of stuff for government employees. And same thing, they got pre-approved. They got multiple pre-approval letters. They found a house, all excited because their daughter has they have special requirements for the house that they need. And then again, like that, it gets submitted into underwriting once they found a contract, and then boom, like the loan got rejected. The whole thing blew up. And again, the reason for that is because the ultimate decision maker, the underwriter, 99.9% of the time doesn't get involved until you actually find a place already. So one of the perks about working with myself, with folks at Fairway, is that we're able to get all those headaches identified and addressed up front. So there's 0 surprises that come down down the road. So again, that's a really, really important perk. So anyway, so that's my goal. Anyone that I work with, I always tell them that I try to get all of your loan stuff done up front before you even go out. It's not that you can't go out, you're still able to do it, but basically throughout that process, I'm going to keep moving forward so that as you go and you start doing things, eventually when you have that full approval, like it's a done deal. We don't need anything else at that point other than the contract from the real estate agent, the appraisal, which is something that my team orders, and then the title work, which is from the company. But as far as the loan stuff, all that is done ahead of time. And then from then on, we're pretty much good to go. So anyway, that's the main difference on that. And that's why it's so important in this market. Again, it's our 3-2-1 program. Last couple slides on here is market trends. So if you've been watching or haven't heard, this is kind of a trend over the last 6 months. So basically ever since the inauguration, the last couple weeks, rates have gone up literally for the most part every day since then. Everyone in the mortgage world has kind of anticipated that rates were going to go up some this year, but most folks anticipated that would kind of be towards the end of the summer, maybe this fall. But they went up, almost overnight within like a couple days time frame in early February, and they've continued to go up pretty much ever since then. Rates right now are roughly about 2.5 for a traditional 30-year conventional loan. Again, your government loans, VA loans, FHA loans will be a little bit less than that, but they definitely have gone up. Roughly about anywhere from 0.25% to 0.5%, depending on the loan program. Over the last 2 to 3 weeks. So it's important just to kind of be aware of that. This next slide that I've got, and again, that's basically the highest that rates have been over the last 6 months. 6 months and some change. So we're looking, most of last year was in the low 3s, high 2s, and now we're kind of already creeping back up there. This last one just kind of goes over general the last 5 years. So even with rates going up, they're still at ridiculously low levels, historically speaking. Anything in the low 3s, and again, where for years and years and years, anything in less than 5 has been awesome. So I think that generally speaking, that probably anything in the 2s is pretty much gone at this point. I mean, we'll see what happens down the road. But most folks will think that where we're at now will probably be pretty consistent. Hopefully we'll kind of level out for the rest of this year, but they've definitely gone up probably for the long haul moving forward, probably in the low to mid 3s at this point. So anyway, that's just kind of a couple things, kind of overview as far as the market goes. So, and that is basically it. So my name is Justin. I'm going to turn this thing off. Give me 1 second. There we go. So again, I appreciate your guys' time, and hopefully the information is beneficial tonight. Already a little bit after 8, so I will zip my lip. Again, hopefully this has been informative and helpful. If there's any questions on anything at all, I'd be happy to answer any of them that you've got. But if not, I'll just kind of open it up for Q&A if there's any. So anybody have any questions on anything? I know it's a lot of information real quick.
Yes, Justin, I have a question. In this market that it is very competitive. I question, how can we wait until it is approved? It takes, 15 to 20 days to get approved. How they can approve completely if we don't know the price of the house exactly, we don't know the taxes, the interest rates, all those points to be approved. I don't understand how can be approved without any of those information.
Yeah, really, really good question. So kind of 2 things. One is that for most folks, we don't need to wait to get pre-approval. I'm sorry, let me rephrase that. Pre-approval is done really, really quickly. Full approval takes a while because it's got to go through underwriting. So folks don't have to wait for full approval. It's just beneficial for those that are able to do it. So what I usually tell folks that I work with is that, hey, if you're not buying a home tomorrow, I'm going to go ahead and get the ball rolling, and we're just going to keep it rolling until you've got it. As far as all the numbers and stuff, again, the way that I kind of explained it is it's almost like getting pre-approved for a credit card. So you might get pre-approved for a credit card of $5,000, but you have no desire whatsoever to spend $5,000 at any point. You might only have, maybe buy some furniture and you spend $2,000 or something. So generally speaking, the way that the program works, so when I work with folks, is I get a ballpark for what their ideal payment is going to be and their ideal purchase amount is going to be. And then I usually get them fully approved for sometimes 25 or 50 grand more than that. So for example, if you're looking at homes at, 450 or 500, I might get them fully approved for 550 or whatever the number is, significantly more than that. Because once you have that max approval, I can always go down, but I can never go up.
Yeah,
and that's why
that's what I am saying. How if you fully approve for 500,000? Okay, I have the letter through approved for 500,000. I find the house for 500,000. The taxes are gonna be about 4,000 or 5,000, depends of Loudoun or Fairfax and so on. So it's gonna be like 4,000 or 5,000, and so the interest rate is gonna be it's gonna go above the 500,000. I don't understand that.
Yeah, so again, it's basically getting approval for a maximum amount. So it's going to be, again, if folks are looking and, let's just say that they're looking at 500. Again, I'll usually get them fully approved for 550, and I usually will qualify them or get them fully approved at a rate higher than whatever is the current going rate. So if rates are 3%, I'll get them a maximum of 3.5%. to make sure that that's a full amount of the full payment that they're qualified for. Because the way that underwriting will work is that they will do it by payment amount and a max interest rate. So that way, again, we know that worst case scenario, they're fully approved, and from as long as it decreases from there, everything is good to go. Again, it's kind of like a credit card where you can't go over your max available cash, but you can always go less than that. So usually, again, I'll usually get a full approval for significantly more, $25,000 or $50,000 more than what people are actively looking for. And then the rate that I will use will be usually 0.25% to 0.5% higher to make sure that, again, that there's no surprises and that things come down through the process instead of going up. Does that help?
Yeah, thank you.
Very, very good. Very good. Excellent question. Excellent question. Any other questions?
No, just, thank you so much. It was great information, and then thank you for your time.
Yeah, thank you so much for being here. Marvin, any questions at all from you guys?
No, I got all the questions answered. Thank you, Justin.
Yeah, I know we've talked a lot, man, but I just wanted to make sure. So
Yeah, I can answer all my questions now.
very good. Okay, great. Well, as always, if you guys need anything one-on-one, just let me know. But again, I appreciate your time and the opportunity just to kind of go over some things. And again, if you have anything in the meantime, just feel free to let me know. And if not, we'll be in touch soon. Hope you guys have a great evening and a great rest of your week if we don't talk soon. So you guys take care and let me know if you need anything.
Okay, thank you,
Thank
Justin.
you. Good night.
Good night. Thanks.